you're going to be close to those you regulate, and you're going to hear their problems and their concerns and not hear those of others whom you're more distant from. And so there is an incentive in regulators to often favor the institutions that they regulate. And this need not be corruption. It may simply be the nature of things. You just hear more information from these people. If you recall, when the Treasury Secretary during the early days of the global financial crisis spent every day talking to the large money center banks. And he wrote about it in his biography, Paulson did. And Paulson is an extremely honorable man. But in order to sort of deal with the problems during the global financial crisis, you've got to talk to the big players. And therefore, you hear their concerns. So I would say it goes with the nature of regulation that you're almost bound to hear those kinds of concerns come up. Now, I think what is more problematic is not so much the regulatory capture, which you have to be aware of, you have to guard against, but it's sort of a narrative capture that you have a sense of the system and how it works. And that gives you a certain amount of confidence, which may be misplaced. What I thought was problematic before the global financial crisis was the sense that the smartest people in the universe were in Goldman Sachs and in Morgan Stanley. And if they were so smart, how could they get into trouble? They obviously knew ways of hedging themselves, of managing their risks, etc. Except it turned out the incentive structure wasn't aligned with them, taking adequate precautions. And as a result, the energies of some of those banks went in directions which were problematic for the system. So with the regulators saying, here are smart people, they'll get it right, there was a missing sort of piece there, which is, do they have the right incentives to get it right? And I thought that was what sort of failed us during the run up to the global financial crisis. It wasn't crime, it wasn't corruption as much. I'm sure there were elements of that, and I have no doubt we have some evidence of it. But it was more that the belief was the private sector will get it right because they're so capable. And it turns out they can get it wrong also. We certainly have upped the amount of capital that we want these institutions to run with. Remember, there were instances of banks running on 50 to 1 leverage. And that meant there was very little margin for error. Now, you can think of capital in a number of ways. One is, it's a license to operate. So you need to convince enough people to put up capital to allow you to operate. That itself is a challenge for some, shady operations. But second, it's also a buffer. In case things start going wrong, it gives the regulators, it gives the supervisors time to react, because there's a certain amount of buffer you have to burn through before you become a problem for the system. So both from the license to operate as well as the buffer is important. But I think also we've put a lot of emphasis on governance and on compliance. And therefore, some of the, when the regulators see something going off track, they do come in. I should keep saying supervisors rather than regulators. They do come in. They do look at what's happened. And banks now are, recognize that they'll be fined enormous amounts if they're shown to be non-compliant. So in that sense, there is a lot more fear that, if you don't do things by the book, you will get penalized. So that's a certain amount of implicit capital over and above the explicit capital that they have at stake. Lastly, I think this is important, for personal incentives. There's a lot more of a focus on clawback. Now, I don't think that people who took big risks, ever doubted their own capacity to make good and make lots of money. But if you're at the back of your mind that you're putting all the bonuses you've earned over the last so many years at stake, when you take these really big risks, you have more of an incentive to behave, right? In the same way as when these investment banks were partnerships with the stake of the partner at risk if the bank collapsed, they were a little more sober about risk taking relative to when they became public limited companies. So I think the clawbacks of salaries and bonuses have helped at the margin, but I would say more than that has been the emphasis on capital, the emphasis on compliance, all of which have made the banking system certainly safer. Well, eventually the system gets used to low interest rates. But I think what is most dangerous is when you move from a system of higher interest rates to a system of lower interest rates, when a number of entities like insurance companies, pension funds have made long-term promises based on higher returns and suddenly find they can't get those higher returns and they have to stretch for yield to get those higher returns. And what we've seen over the last 2 decades is really various versions of that playing out. I can't get anything on short-term fixed income, so let me go longer term. Let me sort of push down the price of longer-term bonds as I buy them, because I really need that extra yield. And then once I've exhausted longer-term sovereign bonds, let me move to emerging market bonds. Uh, there are also sovereign, but less credit worthy than developed countries. And then I go to, bonds of corporations in the emerging markets and so on. I go down the risk spectrum, and I'm desperately trying to get that additional ounce of return without thinking of the additional risk that's taken. And there's a version of, if I take safe assets or hold safe assets, I'm dead, and might as well gamble for resurrection by taking a little more risk. It's not as blatant as what happened during the savings and loan crisis, but there is a certain element of I won't survive if I don't take more risks. So I move into equities, I move into high yield bonds, and so on. I think that is prevalent. Over time, as we get used to these low interest rates, we will not make such big promises, and we will ask people to save more to get that level of pension that they want. We will ask for higher insurance premium, but the transition from a high interest rate environment to a low one is particularly problematic. The other, of course, is to what extent do low interest rate environments make you sort of focus on the really long term? And the really long term is an area of great uncertainty, right? You can build dreams on that. And so whether the speculative element gets emboldened or gets more shape during a period of very low interest rates. I mean, we've seen all the tech firms with promises way out in the future. I'm making strongly negative earnings now, but don't worry, 10 years from now, I'll be the next Amazon. And we have 50 other companies which are going to be the next Amazon, and they're priced accordingly. Whether that speculative element gets weight, I'm sort of saying something along the lines that Giannakopoulos at Yale talks about, whether you're empowering the speculators, the optimists, I should say. That's also a question. Broadly, I would say that what would be helpful is a reasonable interest rate, not a wildly fluctuating interest rate over time. And so the system sort of gets used to it, but obviously that may interfere with what is needed from a monetary policy perspective. As you said, if R-star is really low, we need the nominal to move down to that level, or perhaps lower still, in order to energize the economy. Clearly, in the time before the global financial crisis, there was no such thing as a deep crisis in industrial countries, right? The last one had been 70 years before. The SNL crisis in the 80s could be considered a crisis, but that wasn't monetary policy. Well, sort of, but that was regulatory aberration, supervision. So there was a sense that you could compartmentalize monetary policy since financial stability wasn't a big issue. Basically, monetary policy could focus essentially on macroeconomic issues. And I think the global financial crisis essentially flipped that over and said, look, you need to worry about this other stuff also. And of course, the response from a number of macroeconomists has been, yeah, but let's not overtax monetary policy. Let that be macro-prudential supervision. Let's give it back to the central banks, but in their avatar as macro-prudential supervisors, let them take care of those problems. And so we can continue focusing on low and stable inflation. But I mean, many of us feel macro-prudential supervision, first, is not really conducted in the United States. There is no authority which has separate responsibility for that. And second, when you're pushing on the accelerator, the monetary policy accelerator, macro-prudential becomes a much weaker instrument and doesn't have as much bite. And so at the very least, there's a need for the monetary policy authorities to talk to the macro-prudential supervisors, but you also have to see, if you're not having much effect, should you use the monetary policy tool where to maintain financial stability? In other words, going back to the earlier point when we talked about volatility, should your policy interest rates move less than would otherwise be warranted, especially on the lower end? Should your unconventional monetary policies be a little less sort of aggressive when you don't know what the effects might be on financial stability?